After the first 2 weeks of the trading year, we've seen some bearish cracks, but the weight of the evidence continues to support the bullish case. While there's no question the bias remains bullish and favors higher highs in risk assets, we do have some concerns, as we always do. In this video, we'll look at some DeMark counts that in and of themselves somewhat have a mixed bag. We'll look at the S&P 500 and then the ETFs for Spain and Italy. In the second week of the trading year, we did see some hesitation. The question is that simply hesitation and we'll move on to higher highs, or is it the beginning of slowing momentum that will roll over? One example, on the second trading week of the year, TLT, or long-term treasuries, outperformed the emerging markets. Not a big deal for 1 week, but a rollover has to start somewhere, so it's something that we're watching heading into the third week of the trading year. We do have some bearish divergences on the weekly chart of the S&P 500 that we'll cover in this video. Nothing too alarming, but good to be aware of. On the bullish side of the ledger, our market models, which are based on price and technical indicators, which are unbiased, are unequivocally bullish at the present time. Intermarket trends, especially on weekly charts, look healthy. Starting to see some MACD crosses that we'll cover during the course of this video. We'll also look at some simple things such as daily moving averages for the major indices and their slopes that tend to support the bullish case. If you watch our videos, you know we're fond of the expression, the charts say what they say until they don't say it anymore. 2 tweets from the last week on our Twitter account at Shivako Capital sum up our approach and our approach going forward. We'll stick with the bullish trends until we see signs of meaningful deterioration. We're happy to become bearish or defensive or add hedges to our portfolios if we see observable shifts. Experience tells us that if we begin forecasting and trying to tell you where the S&P 500 is going in the next 1 to 3 weeks, that will bring bias and our ego into the equation. We're better off making decisions with an open mind and remaining flexible so we can make changes on the fly. In the present day market, the bulls are in control until further notice. The bears are the ones that need a catalyst. We'll remain highly flexible and nimble and long until something changes. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. This is a DeMark chart, a daily chart for the S&P 500 index as of the close on Friday, January 11th, 2013. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Let's look at the 4 daily counts and what they may or may not be telling us at this point. This is the sequential count. 13 came on January 7th. This line here is the risk level. What this tells you is if I shorted on this 13 here, 9 and a 13 is a potential exhaustion level and can indicate a higher probability of a reversal. If I shorted here, this risk level, in a perfect world in DeMark speak, would not be exceeded. So this count is still valid. It's something that we need to respect. With this 13 here, there is a higher probability of a trend reversal. That is the standard sequential count. If we go to the combo count already had a 13 on the daily chart of the S&P 500, and you can see that was a good 13. We had a reaction to it. That risk level is still in play. However, you can see the S&P 500 has closed above that level on 2 occasions, and that level is 1465.64. This 13 is still valid. However, from a probabilistic and anecdotal perspective, just looking at historical charts and having experience with DeMark indicators, when you close above this level, it does seem to reduce the probability that this 9 and 13 is a good signal in terms of preventing more upside here. Now let's look at the aggressive combo signal. You can see here we had a 13, and within one trading day we peaked here. So this 13 here is an excellent signal. 13 here, we've exceeded this level 2 times on a closing basis. Again, anecdotally, typically the best signals see a reversal relatively soon after a 13. Not always. You can come up here and meander around a little bit and then reverse, but the best signals seem to come when there's a quick reversal and you never get closes above this level for any significant period of time. Net bottom line, 1476.89 is a level. So 1476 and change. If you're a bear, all things being equal, you would prefer to see the S&P 500 not close above that or stay above it for an extended period of time. Now let's look at the aggressive sequential count. You can see excellent signal here. You have a 9 paired with a 13, and exhaustion came in September. Here we have a 13 with some weakness, but unlike this 13, where we never closed back above it, now this 13 occurred here on January 4th of this year, and now we have 2 consecutive closes above it. Your risk level in this case, meaning this 9 and this 13 is still active, is again at 1476.89. So 1476 and change. How we use these. Here you have a 9 and a 13, and the market begins to agree with it, and then we have a tendency to pay attention, especially here when you get a lower high, and here when you get a lower low. It's telling you that this 9 and 13, the probability of that being a good signal increases. We don't really have any of that yet. At a minimum, what we would like to see is what's known as a price flip. From this close here, we don't have that yet either. So if we begin to see some indication of a rollover, we would tend to take this more seriously. We respect it and are ready, willing, and able to take defensive action if this side begins to look a little bit more like this side. Now we're shifting gears to a weekly chart up here in the upper left-hand corner of the S&P 500 index. This is a TDST level. Think of it as potential resistance here. The fact that this line has been bolded and doesn't look more like this line here tells you that we have what's known as a qualified TDST bullish breakout, which tells you on a weekly chart here the trend has shifted from down to up in DeMark speak. Typically what you'll find is the odds of carrying to a full 913 in this direction increase when you see this qualified TDST bullish break. So let's look at the weekly counts. If we look at the sequential count, we're on a 911, which would require at least 2 more weeks in this direction to get to a 13. That's the standard sequential count. The standard combo count is on a 9. This 9 is paired with this red 9 here and would require a 10, 11, 12, and 13, or 4 weeks to get to a 13. If we go to the more aggressive counts, and the parameters are just a little bit different, you can see here a 13, excellent DeMark signal. Here, a 13, within 2 weeks, we peaked, excellent signal. Last week, from a concerning perspective, we have another 13. So this 13 here is similar to this 13 here, and this 13 here. Outstanding signal. Within 2 weeks, the stock market peaked here. So yes, this is something to add to our concerns and respect for a potential reversal. We need to see some evidence to back that up. If we look at the aggressive sequential count It too is on a 9 and a 13. From a bullish perspective, because obviously those 9 and 13s are somewhat concerning, these are propulsion levels here. This is a downside target here that's still active at 1326. And your upside teal propulsion targets are magnets in DeMark speak, 1575 on the upside. Typically what you find is this is somewhat of your bull-bear demarcation line, where when you're below this green line here at 1459 and change, and we closed last week at 1472 above this green line. From a momentum perspective, when you're above the green line, the odds of reaching the teal target of 1575 increase. If we drop back down below this 1459 and change, then the odds of moving towards this lower target of 1326 increase. Other potential targets with DeMark tools, 1531, 1557, and again up here in the neighborhood of 1576. 913s notwithstanding, as this chart sits here, it's still bullish. For the 13s to become concerning, we need to see some confirmation. We may or may not get that next week. We'll enter next week with an open mind. Moving out one more time frame, this is a DeMark chart for the S&P 500. It's a monthly chart here up in the upper left-hand corner. I'll not cover the counts here. They're mixed. Some of them are concerning. Some of them imply the odds for more upside. What I will cover, this is a monthly TDST qualified bearish break that occurred when the S&P 500 closed in July of 2008 at 1267. What this told you was right here, the monthly trend had shifted from up to down. What an outstanding signal. 1267 is your close here. This is a huge red flag, or at least pay attention flag. And as we all know, unfortunately, if you're in this business, the low down here in March of 2009 was about 50% lower at 666 and change. Meaningful bearish. We have the mirror image of that now. Off of this low, now we have a monthly qualified bullish TDST break above this TDST high at 1404 and change. Again, last Friday we closed at 1472. This tells you that in DeMark speak that the monthly trend is now up. None of these indicators are infallible. All of these are probabilistic indicators. But what this tells you is the odds seem to favor higher highs. Another good sign is we've got a teal target here that was met. We've exceeded that target. Even though the month is not over, this is a TD line here. These are unbiased trend lines that are drawn by the software based upon Tom DeMark's studies. The fact that this is a solid line tells us that as it sits now, this breakout is expected to hold. The caveat would be that this could change between now and the end of the month. If you didn't look at counts and you looked at this chart in isolation, I would say that this chart, as it sits now, tends to lean bullish. But again, we will enter next week and the balance of the month with an open mind. Now let's shift gears and look at some Etf leaders to see if we can learn anything about the daily counts on the S&P 500 relative to will we get a reversal or will we get an extension of the trend higher. It's a daily DeMark chart for the EWP or Spain ETF. Spain and Italy have been market leaders off the summer lows. If their 9 and 13 counts turn out to be good counts and indicative of reversals that will take place soon, then I would say the odds of the S&P 500 counts being meaningful would increase. Conversely, if the 9 and 13s on EWP and EWI do not hold, and instead they imply more upside. We get good information from a DeMark count whether a reversal takes place or not. If a reversal does not take place, it tells us that the current bullish trends are strong enough to carry higher, and we still get good information. Before we start here, this is your TDST line for EWP. You'll notice in this case it has not been bolded. We're above it, which is a good sign. This is very, very similar to breaking above resistance. We would feel better on the bullish end of the spectrum if this was a qualified break, and numerous things have to happen. It's not qualified yet, but a step in the right direction that we've closed above it. Here, this is somewhat of a mixed bag. Your potential teal target is 32.11 on EWP. We've hit it, which could be construed as bearish. Typically, you could see a reversal there. On the bullish end of the spectrum, though, we're above it. Sometimes that can be a good sign. Let's look at the counts quickly. Here we have a 9 on the sequential paired with a 13. This is your risk level. Mixed bag, but some bullish undertones. This 9 and 13 is still active because this line is not bolded. However, price has closed above this risk level on 2 consecutive days, which typically would decrease, not eliminate, the probability that this is a valid 9 and 13 signal. We would feel a lot better about the bullish end of the spectrum if this becomes qualified here at 31.38. It is not qualified yet, telling us to still respect that 9 and 13. This is the standard combo count. I have a 9 buried in here, paired with this 13. Similar situation. Bullish end of the spectrum, we're above the risk level at 31.22. On the bearish end of the spectrum, this is not a qualified bullish break yet. Let's go to the aggressive combo. I've got a 9 paired with this 13 still active at 31.83. And now let's look at aggressive sequential. Buried in here, I've got a 9 and a 13. I've got one risk level that we've exceeded at 30.82 and another active count at 31.38. Net bottom line, this tells us to keep an open mind about the 9 and 13s on the S&P 500. We'll continue to monitor EWP in the next few weeks to see if it can give us some hints at what may happen with the 9 and the 13s on the S&P 500 index. Shifting gears now, this is the EWI ETF. And keep in mind, these are ETFs that trade in the United States during our trading hours, so they're good proxies for foreign indices, but they're not exact proxies. EWI is really its own beast with a very high correlation to Italian stocks. We have a 9 and a 13. Here's your risk level. We've exceeded it. Tends to be a good sign. However, do not have a qualified bullish break yet, so somewhat of a mixed bag. We're above this teal propulsion target. All things being equal, when you exceed it, that tends to be a good sign. Here on EWI, unlike Spain, EWP, we do have a qualified bullish breakout telling us that the trend on a daily chart for EWI is up. I would say that also increases the probabilities that the trend will continue in this direction, and eventually we'll see this line bolded, meaning it negates, for the most part, this 9 and 13. That has not happened yet, so we have to keep an open mind. Another bullish, potential bullish indication, this is DeMarker 1, DeMarker 2, which is somewhat of Tom DeMark's alternative to an indicator such as an RSI. We've got a 6 period here, and this move under a 6 period. That tends to be bullish. We have a 6 period here, here, and here. So what this tells you is, even if this is a peak here, we will probably come back up and try to make another run, worst case scenario, and under those conditions, you would tend to get a peak like this one here, where it doesn't stay above for 6 periods. What it means to us is this 6 and this 6 also seems to align with this bullish TDST breakout and the fact that we're above this teal propulsion target. Similar situation here. We've got a lot of active counts. We'll keep an open mind, but this 9, this 13 tells us don't assume that the 9 and 13 on the S&P 500 automatically means we'll get a reversal. We need to see confirmation of it while respecting that 9 and 13. This is a weekly standard chart of the Dow Jones Industrial Average as of the close on Friday, January 11th. We have a bullish MACD cross that is in place. This number, the black number, is greater than the red number as of the close, so this is etched in stone in the short run. Typically tells you that upside momentum is shifting from bearish to bullish. Bullish cross, Dow trend was up. Bullish cross in October 2011, eventually the trend was up. Bullish cross, higher highs. Can you get whipsaws, MACD? Yes, you can. Here's a cross. We reversed relatively soon thereafter. All this tells us is that it increases the odds or probabilities of higher highs in the weeks ahead. Same situation here as the last chart. NASDAQ, MACD cross, trend up. MACD weekly bull cross, black over red, trend up. MACD bull cross, black over red, trend up. We've mentioned this in previous videos. It still concerns us. Rally, shorter rally, shorter rally. It's possible that this is even shorter than this rally if that trend continues and we roll over. That has to be proven to us. We do have a bullish MACD cross similar to this, and this, where gains in the stock market followed. So weekly S&P 500 chart as of a close on January 11th, somewhat of a mixed bag. We have those bullish MACD crosses similar to the ones that we just looked at on the Dow Jones Industrial Average and the NASDAQ. One difference here, we have price. It's actually made a higher high here, and we have a weekly bearish divergence in place, telling us that the momentum here is somewhat questionable. Look here where price is. Also look at this MACD histogram. There's a divergence there too. Not the end of the world, not earth-shattering. I think the RSI divergence is much more concerning than the MACD divergence. We'd like to see this divergence cleared, and it just tells us to be open to those DeMark counts and a potential reversal, and the need to remain highly flexible and nimble relative to our long positions. We started buying down here. There's nothing wrong with selling or lightening up here if we need to. The CCM market models, which you can read about on our website, www.shavaccocapital.com, use numerous unbiased and observable changes in market trends to manage risk for our clients. This is a simple daily chart for the S&P 500. The blue line is the 50-day moving average, and the red line is the 200-day moving average. This helps us with long-term trends and smooths out volatility. This helps us with intermediate-term trends and helps smooth out volatility. It's a lot easier to discern a trend looking at this line or this line than it is the stock market itself. Point of the exercise, we have the 50-day moving average turning up after a fairly significant correction. If you've studied your charts, you know that when a 50-day turns up and you're bearish in here, you might want to rethink your position. Like everything, it's not infallible or perfect, but it tends to be something you should pay attention to. There was a correction here leading into October of 2011. And here, the 50-day turned up, and after it turned up here, the general trend changed from down to up. This is the stock market moving higher. Little scare here, turned back up here. From point to point, the S&P 500 moved from here to here after the 50-day turned up here in blue. 2012, July, correction, turns up. You should respect that. Point to point, we moved from here to here. Price is above both the 200-day and the 50-day, and the slope of both moving averages are up. That's what you want to see if you're a bull. Same concepts here with the NASDAQ 50-day in blue, 200-day here. One other element here the bullish turn up in the 50, 50, 50, gains followed. Turn up in the blue 50, gains followed. The 50 is turning up here, which is similar to this point here, and this point here where gains followed. We also have what's known as a golden cross taking place, which is when the 50-day moving average crosses above. What that tells you is that the intermediate term trend is now moving back above the long-term trend, which tends to be a good signal. As of Friday's close, the 50 closed at 29.93 and change, and the red or 200-day is 29.92 and change. So technically, we have a cross here, and all things being equal, gains in the stock market tend to follow. Similar situation on the daily chart of the Dow Jones Industrial Average as of the close on Friday, January 11th. 50-day turns up here. Gains in the stock market follow from point to point. 50-day turns up here after a correction. Gains in the stock market follow from point to point. 50-day turning up blue in a bullish manner after a correction, which is similar to this point here and this point here. We also have price above the 50-day and the 200-day. 200-day trying to turn up as well, along with the 50-day. This continues, gains tend to follow. We'll close here with a weekly risk-on, risk-off chart that we've looked at in the past. This is the S&P 500 relative to IEF, which is intermediate treasuries, the IEF ETF. When the ratio is rising, stocks are in favor relative to bonds. As the ratio rises here, the stock market is rising here. This is what risk off looks like here. Weakness in the stock market follows, risk on, stocks do well, etc. We've been looking for weeks or months at this indecisive triangle. I think you can say now there's no question that the triangle has resolved itself, at least in the short run, in a bullish or risk-on manner. Resistance for the ratio, weakness in stocks. Resistance for the ratio, weakness in stocks. Resistance for the ratio, weakness in stocks. Resistance for the ratio, little bit of weakness in stocks. Here, we see something different. Here's a breakout. That's bullish for stocks and bearish for bonds relative to stocks. Did come back down here, but we held here. You can see the ratio of stocks to bonds has made a series of higher lows. Low, here's your first higher low. Here's your second higher low. Here's your third higher low. And now we're trying to make an important higher high here. It would be bullish for stocks and bearish for bonds relative to stocks if we can make a higher high here. What are the indicators telling us? Well, first, this is resistance, and it needs to be respected. Last time we came here, if I move up, stocks did poorly, so we have to watch and see what happens here. Obviously, a breakout would be good for stocks. A reversal would be bullish for bonds and bearish for stocks. The indicators on this weekly ratio chart, so the indicators are tied to this ratio of stocks to bonds. Bullish MACD cross, ratio tends to do well. Bullish MACD cross, for the most part, the ratio tends to do well. Bullish cross, gains in the ratio followed. We have a bullish cross in place as of the close on Friday, January 11th. Typically what you'll find is when rate of change for the ratio is above zero, the ratio rises, that's good for stocks. Ratio, rate of change above zero, good for the ratio, stocks do well. Ratio above zero, risk on. We have the ratio above zero again. Have to admit this looks a little bit tentative here. Would like to see that pick up. From a potentially bearish and reversal perspective, that would align with the DeMark counts. RSI, resistance, 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 and we're at resistance. Again, we have to respect that. On the bullish end of the spectrum, this is Williams percent R, or momentum for the ratio of stocks to bonds above. Here's the stock market. When Williams percent R moves into overbought territory, stocks tend to do well. Williams percent R for the ratio in overbought territory, the stock market tends to do well. Overbought, stocks do well. Right now, overbought looks similar to this period, and this period. Similar with TSI, bullish cross, stocks here do well. Bullish cross for the ratio, stocks do well. Bullish cross, stocks do well. We have a bullish cross trying to form here. ADX is measuring the strength and direction of a trend. This is ADX for the ratio of the S&P 500 divided by IEF, or risk on relative to risk off. If you're a bull, you'd like to see green above red as it is now. This tells you the strength of the trend, the black line. The fact that it's low tells us that we have a sleepy or trendless market, which makes sense. We were in that triangle for a long time. It was very, very difficult for anyone to make money in the stock or bond market. This sleepy or trendless ADX here tells us that a fairly sharp move is probably coming one way or another. As of the close on Friday, it also tends to side with the bulls. Why? We're sleepy, we're rising, and green is above red. I'll caveat that with ADX historically is known to give head fakes in the short run. So this may look bullish, then it may look bearish for a time, and then eventually it may turn bullish. It's just something that we have to keep an eye on. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.